Welcome to Pique Your Interest, your go-to podcast for all things mortgage and real estate. Hosted by Tanner Greenwald and Tim Milauskas. We bring you expert insights to help you buy, sell, and invest with confidence. Let's dive in.
Welcome back to Pique Your Interest. Today we are talking to all of the self-employed folks, the freelancers, the hustlers, the business owners. Being self-employed is kind of an American dream, right? Like it's something that a lot of people strive for. You're your own boss. You make your own hours. You do your own thing. There's a lot of good to it. There's also a lot of risk to it. As anyone who is self-employed will tell you, there's a lot of responsibility that falls on your shoulders that does not exist everywhere. And part of that is, there's not a certain amount of money that you're guaranteed to make. And, when it comes time to file taxes, this is kind of when a lot of self-employed people get sort of hung up with what's going on. You trust your CPA to help you out as best they can. And, they find all the tax breaks that they can for you. But, here's the trap that a lot of people fall into. Say you make $200,000 as a business, give your, all of your receipts and all of your invoices and all of the income docs that you have and all of the expenses that you have, things like, the meals that you've eaten, the, depreciation, other business expenses that you have, you write off vehicles or houses or something like that. You give that to your accountant and, that $200,000 that your business brought in gets shrunken down to, like $50,000 or $60,000. And you're like, this is great. This is awesome. I'm not paying a lot of taxes. The flip side to that is when somebody like me gets a hold of your tax returns and we look at it and we're like, well, you actually didn't make $200,000. You made, $50,000 or $60,000. And that's the income that you're using to qualify. That makes things kind of tough for self-employed folks. So, here's what we do. There's a solution to this. Obviously if going a traditional route, the way that everybody else gets mortgages with analyzing tax returns and W-2s and 1099s and things like that doesn't work. There are alternatives. So there are two that I'll talk about today. One is if you're buying a primary residence, and the second is if you are buying an investment property. So we'll start with the first one. If you're buying a primary residence, in cases where you are buying a house to live in, to call home, and you're self-employed and your taxes are not favorable for doing that, one of the things that we can do is we can do a bank statement loan, and it's just like what it sounds. Instead of tax returns and W-2s, we ditch those documents and we collect bank statements for the last year, and in some cases 2 years, and analyze the income that comes in to those accounts. So let's say you have a dedicated business account, all of your cash flow goes into that, all of your expenses are written out from that. We look at the income that comes into that account, give, some sort of factor of, hey, obviously you're not netting all of the money that you bring in, that's your gross, but there are also expenses that you do have in real life. And so we take that into account. So usually there's like 50%, depending on what your industry is, we'll count 50% of those that income. And so we use that income then to qualify you to buy a house. And in a lot of cases that ends up being significantly more than what you would have on your tax returns. There is a trade-off, right? Like the risk in doing that type of loan is a little bit more. So the down payment requirement, the interest rate, both of those things may be a little bit higher. But the bottom line is it allows you to get into the home that you want to buy, as opposed to, wishing you could qualify for something that you don't through traditional means. So that's if you're buying a primary residence. If you're buying an investment property, and this is one of the hottest buzzwords in all of real estate right now, it's the DSCR. And what is that exactly? It's a very, very easy to qualify for loan as far as, there's no income documents required at all. So looking at, pay stubs or W-2s or 1099s or tax returns are not something that we do. Essentially, if you're buying an investment property, we look at two things. One, do you have enough money set aside in, one of your accounts, whether it's business or personal or whatever, to pay for the down payment and closing costs? And two, this rental property, the potential income that you're going to receive from that rental property, is it greater than the amount that your mortgage payment is going to be? So let's say, for instance, you're buying a house and the monthly payment's going to be, $2,000. An appraiser goes out to the property, determines that the rents you could receive for that property is $2,500. You are good to go. As long as you have the money in your bank, you have enough funds for down payment and closing costs, and that property it brings in more money than the actual mortgage payment, you're approved. And that is the threshold that we use to determine. So it becomes a very easy product to qualify for in a lot of areas because the rental market's still pretty strong. And so if that is what you need to make it work, that's definitely something that we look at. It's probably, again, it's the buzzword. It's something that a lot of people are, very excited about, ask a lot of questions about. It's something that I probably talk about weekly at this point during pre-approvals and in conversations with real estate agents. So it's something that's becoming quite popular. And quite honestly, it's pretty easy. Again, same thing with the bank statement loan. This loan's a little bit different, a little slightly riskier than a traditional product, because we're not really analyzing income or anything. So, the down payment requirement is a little bit higher. The interest rate might be a little bit higher. But again, it allows you to purchase that property that you otherwise would not have been able to. So those are two really good products that are sort of geared for self-employed folks. You still have the advantage of, writing off all the expenses that you have, not paying the taxes, which is really nice, but it also allows you to qualify for the next house. So that's good. One last note I would add is, if you think this is something you're going to be doing, if you're self-employed and you think you're going to be buying a house in the next year or two, talk to somebody like me. Let's make sure that you're on the right track. Maybe you don't need to do a DSCR loan or a bank statement loan. Maybe you could qualify through traditional, FHA, Fannie Mae, Freddie Mac means. But let's get a hold of this, as early on as we possibly can and talk about it, because, if we can have a conversation before you go to your CPA, maybe there's a way that we could figure out to make this work without having to do a bank statement loan or a DSCR. And, if there just isn't any other way, then these are very viable, very popular products that, we're seeing more and more of in the marketplace. So there's definitely an appetite for it. I think there's a little confusion around the products, but that's why people like me are here. We're here to help you and, guide you through that process, figure out which one of those makes the most sense for you. I do appreciate you tuning in today. Again, if you're self-employed, there are multiple ways to get you a loan. Do not feel like you can't buy. I know it's a little harder than it is with, folks who are W-2'd. But it's not impossible. And it's definitely something that we work on, pretty frequently. And again, these products are only becoming more popular. So if you have questions, reach out. If you need anything else, just give me a call, give me a text, shoot me an email, and I'll talk to you soon. Bye.